So in today's video, I'm going to go through supply and demand zones, and supply and demand zones are the way that I did catch the previous trade that I did post a breakdown on my channel. Now, what you want to do first of all when you're looking at supply and demand zones is when you're looking at price action, what we've got right is we've got price, let's just say we've got price coming up like this. So price is coming up like this, and then it ends up right here, and then what you'll get then is a break of structure to the downside. And usually what supply and demand is, or order blocks, whatever you want to call it, it's all the same thing, but it's all put in to different, terms by different course providers and different mentors. Now, what you'll get is you'll get obviously price moving up, for example. In this case, it would be a reversal. And then the last up candle before the down move with displacement and with, aggressive selling to the downside would be your supply zone. So kind of what it would look like is it would look like this. So this right here would be your supply zone. So overall what we've got is we've got price on a upward move, and then eventually what will happen is a reversal will take place. The price has now moved to the downside. It's moved to the downside, with momentum. It's moved to the downside with displacement, whatever you want to call it. What is happening here is the sellers are stepping into the market and pushing price down. And then with that happening, what will happen then is it will leave a supply zone behind, and then what will happen then is that price will return to this area right here, pick up the orders left behind, and then what you'll then be able to do is capitalize on a movement to the downside. Now, this is the exact same thing for a demand zone, but obviously it would be the opposite way around. Now, as you can see, this right here would be our demand zone, and then what you're waiting for is price to come back down to this zone, and then you can wait for a confirmation on the time frame that you're looking for your supply and demand on, or you can go down to a lower time frame and look for a lower time frame confirmation, which would look, sort of something like this. If I just draw it out, if you were going to look for a confirmation on a lower time frame, what you will look for is something like this, right? And then you would then look to get involved on a demand zone which is created within sort of this price leg right here. But there's no harm in just entering simply off this demand zone right here and looking for a confirmation on the time frame that you do find your supply and demand zones on. So this could come in the form of a candlestick pattern or something like that. Now, this is the overall premise of the supply, and then the demand is exactly the same thing but the opposite way around. You will be able to see supply and demand zones in continuations. So let's just say price on this supply, right? Let's just say that price is on a down move, and then it looks like this. So price is trending down. We then get a further break to the downside. This is still classed as a supply zone. It's still classed as a order block. You will be able to get involved in a continuation if you're looking at supply and demand zones. You won't always have to wait for the reversal. So that's one thing to keep in mind when you're looking at supply and demand. So what we'll do now is we'll jump onto the charts and we'll see a couple of examples, and I'll talk through on how I will potentially trade them, and we'll just go ahead and have a look on the charts now. So on the first one right here, what we've got is we've got a simple, sort of a continuation trade. So we've got price right here moving to the upside. So we're making higher highs, higher lows, higher highs, higher lows. And then as you will notice, price does then come down. We get this bearish candle right here, and then we get a really nice push up to the upside in a bullish fashion, leaving behind this fair value gap right here. And this fair value gap is one way that you will then be able to, identify if we've got displacement in the market, if we've got momentum, etc. Now, as you will notice, what we've got right here is a demand zone. So this right here is a trade that I did take, and as I stated before, this is in the breakdown that I did post on my channel. Now, what you'll notice is what happens is we come back down to this demand zone, and then once we see a reaction, you could then get involved. As I said before, you could drop down to a lower time frame. So, this concept right here is fractal. So if you want to look at this on a 5-minute, if you want to look at this on a 15-minute, if you want to look at this on a 1-hour chart, it all is relative and it's all fractal. So you could look at this and you could look at slab supply and demand and order blocks on pretty much any time frame. So what you'll notice is that we come down, we get a reaction, and then eventually what happens is we come up and take out this previous high right here, which could be a target if you were to enter this trade. So jumping on to the second example, what we'll see in the second example, it's pretty much the exact same thing. Now, as you can see, this is a reversal trade. So what's happened on this reversal trade is obviously we've come up, we've taken out a high liquidity, and then now we've started to see a move to the downside. So what we would be looking for is we would be looking for a supply zone to get involved in this right here. Now, for me, the supply zone would be a high probable supply zone to get involved in. It's at the extreme of this down leg. It's got displacement, it's got fair value gaps. So we've got a fair value gap right here. And again, fair value gaps, what these do is it just shows you when displacement has entered into the market, when these sellers have really pushed price down. And then what you're looking for then, like I said before, is a retracement up to this area and then a continuation. Ultimately, what we're looking for is for price to come and take out this low right here, which would be the expectation if we're going to continue in a bearish fashion. Now, what we can do now is see our price does come up and react to this supply zone. As you'll notice, price comes all the way up, and as I said before, you will be able to get involved on the reaction, because as you can see right here, we've got a lovely reaction to this supply. You could have entered somewhere like this, or you could drop down onto a lower time frame, as I said before, and then what happens is price does continue, and ultimately it does go ahead and take out this previous low right here. So what we'll do now is we'll jump on to the last example, and this one is a little bit more complex, and it's one that I want to put into the video because the simple fact is you don't always know where price is going to react to. As you will notice here, we've got a really nice breakout structure, you know, and then obviously the sellers did step into the market right down here. This is a very big demand zone, but it's been mitigated by this right here, and mitigated, all that means is that price has come down and tapped into this. Sometimes what you'll notice is that price will come down to the, you know, equilibrium of a demand zone like this because it's so big. But as you can see, what we've got is essentially we've got two demand zones on this leg of price. So we've got one right here, and we've also got one above right here. Now in situations like this, what we will get is sometimes we will get price come down and react to this one and continue, or sometimes what we'll get is we will get price come down to this one and then continue and essentially take out this demand zone as liquidity, using liquidity to be fueled to, you know, fuel the move to the upside. Now let's see what happens to this trade. So what happens now is that price does come down, it does violate the first demand zone, as we can see right here, and then once we come in to this, you know, more extreme demand zone, we do get a beautiful reaction to this demand. So you could have entered somewhere around here, you could put your stops below this demand zone, and then you could target, like I said before, the previous high, because the previous high right here is the expectation of this high to be taken out. So this could be a conservative target if you were trading like this, or you could again drop down onto a lower time frame and look for something like this, return to the demand zone that is created on the lower time frame, and then you could, you know, increase your risk reward by getting involved on the lower time frames. So as you will notice, we've got a beautiful reaction right here. We've got a reaction shown by these, you know, massive wicks on the bottoms of these candles, and the price does continue, and ultimately what happens is we do take out this previous high right here, and then price has continued in the bullish trend. So that's just basically what supply and demand zones are. They are very powerful in the market. You know, you can trade this on the higher time frame, you could trade it on a mid time frame, so it could be a 1 hour time frame. You can also trade it on a lower time frame, such as the 15-minute, the 5-minute. And you know, if you want to keep it simple, what we could do is just simply wait for a reaction to a demand zone, and then once you start seeing a reaction, you know, once you start seeing price come back in to this demand zone right here, and you know, price is coming in and it's getting pushed out by the buyers which are left behind in this demand, you could simply enter the trade and then, you know, continue to the upside to take out this high. Or like I said before, if you want extra confirmation and you know, are more confident in getting involved after a lower time frame confirmation and when the lower time frame does shift and create a new demand zone for you to get involved in, you could simply do that and then, you know, increase your risk to reward if that's what you prefer. Basically what the best thing is to do is go into the charts, test out these concepts, and if you like them, what you could do then is build a model around what you know, what you prefer, and how you feel confident entering the market, because most importantly, that is what trading is about. If you're confident to execute your edge, if you've got data around it, if you've backtested it, this is the simple way, you know, that you will be profitable in the market, because, you know, you've got essentially got to go ahead and put in the work. And then once you have done that, you will then have a simple sort of entry model. As you can see, we've come down, we've taken this liquidity below these lows, as I, you know, demonstrated before. Entry right here, and then target the previous high. So it's just that simple, guys. That's the overall process around supply and demand. It's a super simple concept, but it is a very, very powerful one if you do use it in the correct context and you do use it in a, you know, sort of confirmation. So it's just that simple. If you have any questions, as always, feel free to leave them in the comments. Without further ado, thank you very much for watching, and I will see you in the next one.